Hi everyone, welcome back to my channel Ask Parul. So are you an NRI who is looking to optimize your financial strategy? Did you know that NRI taxation rules can be confusing and complex? But don't worry, in this video I will clear all your doubts and break this complex financial topic into simple terms, as I have been in the exact same situation for past 1 year and I realized that there are tons and tons of material out on the internet, but none of them really covers everything end to end. Or it's not that simple enough for you to understand. And that led me to create this comprehensive guide that can hopefully save you on a lot of time. So with the start of this new financial year, we are almost towards the end of May, and with the tax return filing in India until the 31st of July, this is the perfect time for you to understand NRI taxation to ensure that you can maximize your savings, minimize your tax liabilities, and avoid any potential litigations or legal issues. So by the end of this video, you will have an end-to-end understanding of how NRI taxation works, bursting some common myths. So do ensure you watch this video till the end to get all your doubts cleared. And if you do like this video, then do give it a thumbs up. Do subscribe to my channel if you are new to it. And if you are interested in other NRI videos around transferring money, understanding about the NRO account, NRE account, I also did a podcast with NRI Money Clinic, then do check out my playlist of NRI community. So first things first, if you are an NRI, it's important to understand your tax obligations in India. So you might be wondering that if you will need to pay taxes in India in case if you are earning income abroad. So the answer to that is yes. In many cases, NRIs are required to pay taxes on income which is earned in India. So one of the key things to consider when it comes to NRI taxation is your residential status. So your residential status determines how your income will be taxed in India. There are different criteria that determines whether you are a resident or you are a non-resident, and it's essential to understand how those status affect your tax liabilities. Another important aspect NRI taxation is the tax implications of different types of income, such as your salary, rental income, capital gains, and much more. So understanding how each of these type of income is taxed can help you to make much more informed decision about your finances, and it will also ensure compliance with Indian tax laws. So whether you are an NRI who is looking to understand tax obligations in India, or who are somebody who is just interested in understanding about the NRI taxation, then this video will provide you with the valuable insights and information. So this guide has a total of 5 sections. So section number 1 will be determining raw residential status. Then we'll talk about income types and sources. We'll also look into income tax slabs for NRI and capital gain tax. We'll also look into the tax-free instruments and exemption for NRIs. And finally, we'll look at the common misconceptions around NRI taxation. So section number 1 is to determine if you are an NRI or not. So the first step in understanding NRI taxation is to determine your residential status. So this is generally based on your physical presence outside of India during the financial year. So the general rule of thumb is that if you have lived outside of India for more than 182 days in a given financial year, then you are considered an NRI for tax purposes. Now, it can also vary depending on your own unique circumstances, and there are some other conditions that determine whether you are an NRI or not. So I'm going to be putting a link in the description link wherein you can just check as per the calculator whether you are an NRI or not. But for simplicity's sake, the general rule of thumb is 182 days in a given financial year. If you have spent outside of India, yes, you are an NRI. So section number 2 we will talk about is that income tax for NRIs. Now what's taxable and what is not taxable. So we will divide this section into 3 different parts. The first part we are going to talk about is the types of income. The second thing we are going to talk about is the income sources. And the third thing we are going to take a look is the income tax slabs for that income. So the first part is the type of income. Now, when we are looking at the type of income, it's very important to understand whether your income is an Indian income or it's a foreign income. Now, this is generally based on the concept of accrual versus a receipt. So accrual of income means that where the income is generated. So for example, it could be a rent that you have generated in Indian property, capital gains from the sale of assets where the origination is India, interest from the bank accounts which are in India, let's say an NRE or an NRO, versus the receipt of the income. So where this income has been received. So most likely it's going to be in your Indian bank account. Let's say your NRO account or an NRE account. And if you don't understand what an NRO and NRE account is, then check out my latest video around the differences. And also remember that the tax in India is applied only on the Indian income and not on the foreign income. So basis this, it can lead to 4 different scenarios. Scenario number 1 is if your income has been accrued in India and received in India, then yes, it's an Indian income. If it has been accrued in India but not received in India, then also it's an Indian income. If it has been accrued not in India but it has been received in India, then again it's an Indian income. And scenario number 4 is that if it has not been accrued in India and it has not been received in India, only in that case it's a foreign income. So don't worry, I know it can be confusing. So let's just take a quick example. So consider Mr. Raj, let's say, he's an NRI who is living in the US. He owns a property in India through which he earns a rental income of rupees, let's say 40,000 per month. Now this income is taxable in India. Why? Because it has been generated in India. So the accrual has happened in India. However, his salary income, which is earned in the US, is not taxable in India because it's a foreign income and it has not been accrued in India, and most likely he has also not received in his Indian account. So in this case, his salary income earned in the US is a foreign income. However, the rental income which he has generated, no matter if he has got in his Indian account or he has not got in his Indian account, it is still an Indian income. So he has to keep that in mind when declaring income tax in India. So that's also where the double taxation agreement comes in. But just to keep things simple, I would probably not go into double taxation agreement. So for now, you can just keep in mind that you can't be taxed twice on the same income. So in this case, if he is being taxed in India for his rental income, which is generated in India, and provided India and the US has double taxation agreement, then he can take a tax offset claim, provided he has declared that income in India and provided he has paid tax on that. So just not to get you confusing, just keep in mind 3 simple rules for now. Rule number 1 is to evaluate whether your income is an Indian income or it's a foreign income. And that's generally based on the principle of accrual versus a receipt. The second rule of thumb is that either of them is true if the accrual has happened in India or the receipt has happened in India. In either of these scenarios, it's considered as an Indian income, which is taxable in India. And the foreign income, it would be considered as a foreign income in the country of residence. So in this case, the rental income in India is most likely a foreign income in your country of residence. And rule number 3 is that even if the income is within India, so let's assume it's 40,000 per month, and overall annually it comes less than 2.5 lakhs, which is the basic tax exemption, you would still have to declare that income as a foreign income in your country of residence. And if at all you have paid taxes in India on that income, then as part of the double taxation agreement, which is DTA, you can get the offset in your country of residence, provided that that country has a DTA with India. So if you want to go deep into it, I can create a separate video, but for simplicity's sake, just remember these 3 rules and also check with a qualified chartered accountant or tax consultant in your country of residence. Now, so the second thing that we will talk about is the income sources. Now, there can be various different kind of income that you can generate in India. It can be either through a salary, your business or profession, a house property, capital gains, or it could be other sources. So the third part of this section is that what are the different income tax slabs for NRIs? So in terms of the income tax slabs, I don't think there is a real differentiation between an NRIs or a resident. It's pretty much the same, which means that for the first 2.5 lakhs, it's nil. After that, it's 5%. It gradually levels up to 20% and then 30%. It's a tiered structure, and of course, you can opt for an existing regime, which is the old regime, or the new tax regime. So the tax slab doesn't change as much. But of course, there are some special criteria for the NRIs, which we will look in the next section. So the section number 3 is that how is the capital gains taxation? How do they work for an NRI? So the capital gains is usually one of the biggest chunks of income for the NRIs. So we will do a deep dive in terms of how is it calculated. So capital gains can be calculated either on the income that you have generated by selling the asset. It could be an equity, mutual funds, debt funds, or it could be an immovable property. So the taxation works slightly different for each one of these. So first of all, we'll take a look at the capital gains. How does it work for asset class, which is your, let's say, shares, or equity mutual funds, or balanced or hybrid mutual funds. So for these, we have either it can be a short term or it can be a long term. So a short term is generally something which is less than 12 months. But if you have hold that asset for more than 12 months, it's considered as a long term. So for the long term, the tax rate is 10%, same as a resident. But there is a 1 lakh exemption, similar to what a resident Indian gets. But if it's a short term, then you have to pay 15% as a tax on that. All right. We'll talk about how TDS is different from the actual tax in section number 5. But for now, just keep in mind that if you are an NRI, a TDS of 10% or 15%, depending if it's a long term or a short term, will be deducted and the balance would be paid back to you. It's not the case for resident, however, because in resident, it would be applicable when you are actually filing for the return. But in terms of taxation, the tax liabilities pretty much remain the same, whether you are a resident or you are a non-resident. All right. So now we will take a look at how does the capital gains tax work in case of debt funds. So previously we looked at for equity mutual funds and shares. Now we are going to take a look at how does it work for the debt funds. So it's slightly different for debt funds because in the case of debt funds, there is no such thing as long-term or short-term. It is totally based on your income tax slab rate. And this has changed slightly from 31st of March 2023, which is last year. Now, before 31st of March 2023, anything that is long-term for debt funds was taxed at 20% with indexation benefit, and short-term was as per the income tax slab. Currently, nothing like that, right? It is absolutely as per your income tax slab. And what is long-term and short-term for debt funds? Long-term is anything if you have hold for greater than or equal to 36 months, that's considered as a long-term, and short-term is anything that you have kept for less than 36 months. So do keep that in mind when you're investing in debt funds, right? Because the taxation is slightly different and also the holding period is much higher as compared to the equity funds. So now we are going to take a look at how does the capital gains tax work for immovable property, which is real estate. So in case if you have an asset like an immovable property, then also there is a short-term and a long-term tax rate. So short-term is anything which is less than 24 months is as per your income tax slab rate. And if it's a long-term, which means that it is greater than 24 months, then it is taxed at 20% with indexation benefit. And if you don't understand what an indexation is, then I'm going to be linking in my description link. Go and check that out at how indexation works. So now I'm going to also talk a little bit about fixed deposits. If you have a bank, then you must be getting some interest rate in that. If you have a property, then most likely you would be getting a rental on top of that. So all these things are as per your income tax slab rate. So there is no special restrictions when it comes to capital gains. It's only in case of capital gains where there is different kind of criteria. Anything outside of that, let's say you have a fixed deposit or bank interest or rental, is as per your income tax slab rate. There is, however, a small catch in case of fixed deposits, because if you have a fixed deposit in an NRO account, then there will be a 30% TDS, which is tax is deducted at source. Remember, it's not an actual tax, but a 30% TDS is deducted. If the interest is generated on an NRI account, then that's tax-free in India. I've spoken about that in one of my previous videos. Go check that out, differentiation between NRO and NRI account. But that's where the bank interest is slightly different for non-resident versus resident. In case of resident, it's straight away as per your income tax. TDS is generally just 10%, but in case of NRI, the TDS is slightly higher. Reason being because a lot of NRIs don't file for income tax returns. So the government really wants to collect their tax. So hence the higher TDS is applicable in case of NRIs versus resident. So next section we have is that what are some of the tax-free instruments or exemptions for NRIs to save tax in India. So there are 4 or 5 different kind of instruments. Of course, please feel free to put in the comment box if you're aware of more. But from my knowledge, I'm aware about few instruments which are tax-free, or if there are exemptions for NRIs to save tax in India. So the first one is the interest which you have earned in the NRI account. That is generally tax-free in India. However, like I said previously, you still need to declare as a foreign income in your country of residence, right? So the second is the PPF. So any interest that you have earned in PPF is generally tax-free, just like a resident. But please do note that you can't open new PPF, which is a public provident fund account, as an NRI. You can, however, continue with your existing account, provided it was opened before you became an NRI, and you can continue to make contributions until maturity, which is generally 15 years, or until you have become the citizen of the country of your residence, right? So PPF is the second instrument. The third instrument, just like a resident Indian gets, the NRI also get 1 lakh exemptions in the long-term capital gains from equity or mutual funds in a given financial year. So up to 1 lakhs, you don't have to pay any taxes. However, it's also taxable in your country of residence as a foreign income. But for that, do check the restrictions and the tax calculations in your country of residence. The fourth one is the exemption is applicable to long-term capital gain from the sale of house property. Now, how to save tax on the sale of property in India? There are a couple of key criteria. So the long-term capital gain can be exempted if it is reinvested in a new residential property in India within a year before or 2 years after the sale. And if the new property is being constructed, then the construction should be completed within 3 years of the sale, right? And the second is that the long-term capital gain can also be exempted if reinvested within 6 months in purchasing bonds in specified government corporations. I will be giving the link to this. Go and check that out, at how you can save tax on the sale of property in India. This video is just for education purposes, so do discuss your unique circumstances with a qualified chartered accountant or financial planner. So the final section that we have is, which is that what are some of the common myths around NRI taxation? So there are 4 or 5 common myths around NRI taxation. The first one is that, is my foreign income also taxable in India? So the answer is no. Your foreign income is not taxable in India. It's only the income which I have explained in the previous section, which is either accrued in India, or generated in India, or it's received in India, is taxed as per the income tax slab rate, or as per the special rate if it's a capital gain basis the asset type. Check out my capital gain tax section where I've spoken about how the taxation varies for different kind of asset class. The second common myth is that if I am an NRI, I probably don't have to file an ITR in India. And people generally ask that, should I file my return in India if I'm an NRI? So the answer to that is that, technically speaking, if your income in India is less than 2.5 lakhs, then you are not supposed, technically speaking, not supposed to file an ITR. However, it's always a good idea, even if you're filing as a nil tax, from a compliance perspective. And if your income is more than 2.5 lakhs, then you are mandated to file for your income tax return in India. And the third reason is where the concept of TDS versus actual tax come into play. And that's the third myth, that if TDS has been deducted from my account, this is the actual tax. So TDS is not the actual tax. TDS is just tax deducted at source, something like an advanced tax you can consider. But that's also one of the reasons why for an NRI there is a higher TDS as compared to resident, because a lot of NRIs generally don't end up filing for tax returns. And that's why the government says that, hey, I would be taking TDS, which is at the highest tax slab, because I'm considering that you are an NRI and you would probably have some income in India. And if you want a refund back, then you need to apply for an ITR. Right? So how does it work is that, let's assume if you have 1 lakh of interest which is being generated on a fixed deposit, so 30% of that, which is 30,000 INR, is deducted as a TDS. Now let's assume at the end of the year, even if your taxable income, overall taxable income at the end of the financial year is less than 2.5 lakhs, but because a TDS has been deducted, it's advisable that you actually file for an ITR so that you can claim your 30,000 refund back. If you are not filing for an ITR, you would probably not get that, right? So that's why it's so important that as an NRI, you should always file for ITR in India. So the fourth common myth is that which ITR form is applicable for an NRI. And usually a lot of NRIs still file as a resident and as ITR 1. But ITR 1 is not for non-resident of India. ITR 1 is only for resident Indians. If you are an NRI, there is either an ITR 2 or it's an ITR 3 which is applicable for you. What's the difference between an ITR 2 and ITR 3 is that if you have a business or professional income, then you have to apply for ITR 3. If you don't have that, you need to apply for an ITR 2. The final misconception that people have is that there are different tax slabs for non-resident Indians, which is NRIs versus residents. So that's a myth. Income tax slabs are pretty much the same, something which we saw in the previous section. But of course, there are some special provisions on capital gain taxes and TDS, which we looked at that previously as well. But at the surface level, the income tax slab is pretty much the same if you're a resident or if you are a non-resident of India. That brings us to the end of this video. I know it was quite a long video and quite comprehensive, but I'm hopeful that this would have definitely helped you. Take some time to absorb it. Go through this video 2 to 3 times. Do talk to a qualified chartered accountant and a tax consultant in your country of residence. And again, if you're new to my channel, then do subscribe, do give it a thumbs up,